If your close date is basically a vibe and you only find problems when the client's already asking for reports, this is for you. Today, I'm going to show you the financial close KPIs that actually shorten the close, not just decorate a dashboard. I'm a CPA and I review closes all the time. Clean ones, messy ones, and the we closed but did we ones. What you learn: the 5 to 7 close KPIs that tell you if the close is healthy. How to set targets without guessing. How to use KPIs to find bottlenecks before you're behind. The reviewer checks that catch issues early. Alright, let me explain it in plain English. Let's slow down here. A close KPI is only useful if it answers where is the close breaking. Step 1. Track close cycle time. Define it. Day 0 equals month ends. Closed equals financials reviewed plus reconciliations done plus key tie-outs done. If you don't define closed, your KPI is fiction. Important. Step 2. Track percent of accounts reconciled by day. X. Pick day 3 or day 5 depending on the client. This is the early warning system. I've seen this a lot. If cash and AR aren't reconciled early, everything downstream gets sloppy. Step 3. Track adjusting entries count plus dollar value. Not entries are bad, but spikes equals process gaps. Example, if you have 18 late reclasses every month, that's a workflow problem, not an accountant problem. Step 4. Track flux exceptions, accounts with material variances. Set a threshold like greater than 10% and greater than $2,500 or whatever fits the client size. This is where people mess up. They only look at total P&L, not account behavior. Step 5. Track open items, aging uncleared deposits, old AP credits, AR credits, suspense/clearing. If those age, your close isn't late. It's just carrying debt into the next month. Mini case 1. One time a client swore their close was done by the 10th, but cash wasn't reconciled until the 18th. Their KPI said 10 days. Reality said 18. Once we tracked cash recon by day 5, close time dropped without anyone working weekends. Mini case 2. Another client had perfect close time until we tracked number of flux exceptions unresolved. Turns out they were closing fast by not explaining anything. That's not a close, that's a printout. Here's what reviewers look for. 5 big ones. Definition integrity. Does close complete include review plus reconciliations? Reconciliation coverage. Are all material balance sheet accounts reconciled, not just bank? Aging discipline. Do open items have owners and explanations? Flux logic. Are variances explained with business reasons, not timing? Cutoff sanity. Do revenue, COGS, payroll accruals land in the right period? Red flags. Close time improving while recon percent by day 5 gets worse. Big JE volume in the last 48 hours. Old recon differences rolling forward. Other expense growing with no story. What to check? Cash, AR, AP, payroll liabilities, sales tax, deferred revenue if applicable, clearing and suspense accounts. Always supporting docs that should exist. Reconciliation files with tie-out detail, JE support, invoice, calc or memo, flux notes, short plus specific aging detail for open items. Quick checklist recap. Define close complete in writing. Track close cycle time consistently. Track percent reconciled by day 3-5. Track JE count plus total dollar impact. Track number of material flux exceptions. Track open items aging monthly. require flux notes for top variances, require support for every material, JE review, clearing/suspense every close. Compare KPI trends month over month. If this sounds like your close process, you're not alone. Drop a comment with your current close date target, day 10, day 15, and if you want, like and subscribe. More CPA level close and review stuff coming.